Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference. And I'm here with Matt Bartolini with State Street and Juan Carlos Artigas with World Gold Council. Gentlemen, thank you. There's a lot going on in the gold space. Starting with you, JC, what were some of the things that you saw in 2017? And as an advisor, what do we need to look at 2018 regarding gold?
Yeah, 2017 was a solid year for gold.
Yeah.
The price went up about 13% in dollar terms. And that was in spite of, for example, the Fed delivering 3 interest rate hikes and various other things. So it was, I think, a solid year. Now, when we look forward, which is quite important, we just released our outlook. We're focusing on 4 trends. One of them being, frothy asset prices. So as we all know, in particular, the stock market continues to go up. That is, of course, good for many investors, but at the same time is making many people nervous that there can be potentially a correction. If and when that happens, having gold in a portfolio can help reduce losses and reduce volatility. That's number one.
Right.
Second one is synchronized economic global growth. Oftentimes, global growth is seen as a negative for gold because people think, well, if there's growth, then people are less interested in gold. Actually, it's on the contrary. Economic growth is the foundation, is the basis for long-term price performance for gold.
Yeah.
And the reason why is if people have more income, they will spend more in luxury items, but they also save more. And many of those savings, and of course many of those luxury item purchases, go to the gold market.
Yeah.
So it's particularly supportive around the world in emerging markets and developed markets. The third one has to do with, of course, the balance sheet of central banks and interest rates. As I mentioned before, interest rates have been increasing, and that is often seen as a higher opportunity cost for investing in gold. However, what we need to understand is that the really unconventional and aggressive monetary policies that were put in place over the past decade will still have repercussions into the asset market.
Right.
Interest rates still remain low, and comparatively speaking, and as we saw from last year, that's not necessarily a deterrent. There are many factors that influence the gold market, and there continues to be a good rationale for investing in it.
Number 4.
And then number 4, just finally, is about transparency and efficiency and the fact that the market is trending towards that. As we know, across the world, investors are utilizing gold-backed investment vehicles to access the market.
Yeah.
But there have also been new changes in the environment, for example, in the OTC market in London, where there has been a push for transparency. And that can be replicated around the world, and that has been really positive for gold.
Matt, maybe one other thing is just pure supply and demand. Can you touch on that for a second? And there's just not as much gold to be able to get out of the ground these days.
Yeah, I think some part of that is supporting gold equity or gold prices broadly, but the demand part is not going away. To JC's point, there's been still consistent demand for gold, and specifically when we talk to advisors about gold ETFs within portfolios, because of that benefit of portfolio diversification that gold can bring because of its low correlated structure.
Yeah. So obviously State Street represents the biggest and most popular option out of all ETFs, GLD. Been around for a long period of time, and also you have GLDW. Maybe touch base on that for a second.
Well, I think there's a different type of gold exposure that you would need for different types of environment. So in a strengthening dollar environment, GLDW would perform better than just a strictly gold position like GLD because of the impact the dollar has on gold prices. Now, because of the environment we've been in, where it's been a lower or weaker dollar environment, GLD has actually been able to still provide that diversification benefit that you do have, but also benefit from the weakening dollar, furthering returns that gold can give you in this type of environment.
Yeah. So first and foremost, the message is make sure you consider this if you don't have it in your portfolio or your client's portfolio, because we're now at 10 years since the last beginning of a bear market. And are you protected? Are you diversified? And number 2, there are a lot of choices in the ETF space. There are a lot of people that are diving into the space. There are things like assets tracking, liquidity, spreads that are really important that you take a look at, right?
That's right. So when we think about portfolio construction overall, it's the due diligence process of the ETF that you're going to put in there. So we always think about total cost of ownership, ensuring that is there for your portfolio. But then also the diversification element is really key because, as Juan Carlos said, equity prices are continuing to move at all-time highs, and pretty much everything in the capital markets last year went up, from bonds to equities. And that likely will continue to melt up as we get into 2018, but you can't just throw diversification out the window. Like Harry Markowitz said, it's the only free lunch.
Excellent. On that point, thank you, gentlemen. Really appreciate it.
Thank you, Tom.
Thank
Thanks
you.
for having us.